Hi, I'm John Pasalis, housing analyst and founding broker at Realosophy Realty, where I lead our team of agents in providing data-driven real estate advice to home buyers and home sellers throughout Toronto and the Greater Toronto Area. We launched this Toronto Real Estate Summit because we're getting a lot of questions from consumers about the volatility in our economy and our housing market that was brought on by the COVID-19 pandemic. So we're going to be talking to leading economists, housing industry leaders, personal finance experts, and real estate agents to get a better understanding of what's going on in our markets today and what are some of the key things that we should be looking for in the months ahead so you can all make smarter real estate decisions. If you have more specific questions about your home buying and selling needs, please feel free to email me anytime at askjohn@movesmartly.com, and I hope you enjoy this interview.
Hello, I'm Urmi Desai, head of content at Realosophy and editor of MoveSmartly.com. My next summit guest, Hilliard MacBeth, is a financial planner and the author of several books, including When the Bubble Burst, Surviving the Canadian Real Estate Crash. Hilliard has a very active following on Twitter, and he's especially beloved by housing bears, those who believe there will be a significant drop in home prices soon. A group that incidentally includes today, post-COVID, Canada's top housing authority, the CMHC. Welcome, Hilliard. It's good to talk to you.
Nice to be on your show.
So let's start with your book, which you first published in 2015. I'm just going to pull it up here. Lovely cover image. So you first published this in 2015, When the Bubble Burst, Surviving the Canadian Real Estate Crash. So
yes.
Very on the fence title.
yeah, we didn't want to be ambiguous at all, no.
So can you tell me a little bit about why you wrote this book?
So the first edition came out in 2015, and I started noticing years before that in my work as a portfolio manager for many clients, at that time it was about 36 years that I had doing that. They started to develop probably in about, of course, I'm based in Edmonton, Alberta, so probably in about 2003, 2004, they started to develop an unusual interest in real estate, and it was quite dramatic. So having that many years, more than 3.5 decades of advising individual investors and watching them go through all the stages of accumulation and retirement and all that sort of stuff. When they change, when they start to shift, especially if you notice it among many people that you talk to, it stands out. And this was really quite unusual. Like a couple of things I remember. One client said, "Well, we're going to buy our daughter a condo in Montreal because she's going to McGill University and she needs a place to live." And I'm kind of going like, well, there's lots of apartments to rent in Montreal. Montreal has the largest number of apartments to rent in Canada. It's not required to buy a condo, but they said, "Oh no, it'll." I said, "Well, what do you do at the end of the 3 or 4 years?" And they said, "Oh, it'll be a good investment." So, I'd never heard that before. I mean, that was new. That was unusual. And then another client I remember said, "I'm going to cash in my RSP." Now, as Canadians, it's kind of like almost like a religious thing to never cash in your RSP because you have to pay all this tax when you take money out of the RSP. And I'm going to cash in my RSP and buy rental properties. So I said, what is going on? So I started to investigate it, and it turns out that we were at that point. It was the early stages of the formation of the bubble, and then 2009 came along, and the big crash in the U.S., the 40% drop in house prices. And I thought, well, okay, that's the end of that formation of that bubble. No, to my amazement, Canadians went even bigger into the housing bubble, and then by now it was definitely a bubble, and it was the mania was gaining steam, and of course there were, as I point out, there were some government policies that really helped people get excited about real estate, and it carried on from there. So by 2015, it was time to put it into writing. It was easier for me to put it down in a book and do all the research and all that than try and talk to people because it was basically going to be a point of conflict between me and my clients if I kept sort of nagging them about their real estate, about their love for real estate. So was better if I put it in a book and then they could decide to accept it or reject it separately from our other relationship.
So let's dig into a little bit of that, your book and the main arguments in it. What is your definition of a real estate bubble?
Well, there's no technical definition of a bubble. I think Robert Shiller has probably the symptoms of a bubble, and it's not that scientific, although he did win the Nobel Prize for proving that bubbles exist and that they do happen. So as Shiller points out, all bubbles have these features in common, and they're quite stark and quite recognizable. It's not, you could say a period of rising prices where prices double or triple within a short period of time. So Shiller says, and Robert Shiller has, by the way, won the Nobel Prize a number of years ago. He's been tracking cycles for a long time. He's based at Yale University and written a book called Irrational Exuberance in about early 2000s, I think. So he was talking more about the dot-com bubble, but he also talked about the real estate bubble in the U.S., and then he's updated the book since then. So rapidly rising prices, well, we certainly had that in Canada in general. Basically, on average, Canadian prices have tripled in the last 20 years, as recorded by the Real Estate Index. People tell each other stories in an attempt to justify the bubble. Well, I could talk for a long time about this. As a result of the book, I've interviewed with people all across Canada, and everybody has a different story to justify the bubble in their area. And not only does it go by city, like in Edmonton, it was the oil sands. In Toronto, Toronto's a world-class city. In Vancouver, it's foreign money coming in. Everywhere, everybody has a story, but it's a different story every place you go. It's quite interesting. And then now that there are some signs of the cracking of the bubble, everybody's got a story why their particular city or their particular neighborhood or even their particular house is exempt from. So of course, people in Toronto say, of course, Vancouver's going to have a crash because, and Alberta's going to have a crash because of the oil price collapsing. But Toronto will be special. Toronto will be, especially my neighborhood. So that the stories are abundant. People experience envy and regret if they are participating. Well, this is the big one. I mean, fear of missing out is just absolutely all across Canada, and of course the news media get involved. Well, it's pretty amazing how involved the news media are, especially in Toronto. The Toronto Star and the Globe and Mail, the Business News Network on TV, owned by CTV, and they're all heavily involved in talking about this. And then, of course, bubbles are for a mental illness. Now, when you use the word bubble, it sounds kind of innocuous, but really, when you're risking hundreds of thousands of dollars of debt on the idea that house prices will continue to go up, even though they're tripled already, that requires a pretty strong mental effort to deny the risks that are going in. I first really noticed this when I talked to young couples that told me that they were considering taking $1 million loans from banks, major Canadian banks, to buy a housing, and I just couldn't imagine it. So I talked to them about how much money that means. At least, even at today's interest rates, that's at least $1.5 million would have to be paid back over 25 years. Divided by 25, it's just whatever. It's $40,000, $50,000, $60,000 a year going to repay the mortgage. And then I realized they had absolutely no intention of paying back $1.5 million over 25 years. They were going to buy that $1 million house, and it was going to go to $2 million, and they were going to sell it. They were going to repay the debt that way. So all kinds of mental gymnastics are required to convince yourself that the bubble is safe to get involved in. And so after the book came out and all the interviews I did over the last 4.5 years, it's become clear that three things are true. People believe in Canada three things: house prices always go up. Mortgage debt is good debt. There's no instance where you take out a mortgage where it's a risky thing. It's always a good thing to do. And there'll never be a financial crisis in Canada. Those people believe that, and they believe it from Halifax to Vancouver. They believe it not just gently; they believe it firmly and strongly. It's an amazing thing that's happened just in the space of maybe a decade or two. Having been around as long as I have, I can assure you that that was not, none of people didn't believe any of those things prior to the formation of this bubble. This is all new, and this is what's so hard for people to understand. Is this is brand new, and it's also never happened before.
So for how long do you think we've been in this bubble? When did it form?
Well, I think people started telling themselves stories about the bubble. The early days of the bubble probably are 2002, 2003. There's, we'll never know. I mean, one of the most popular books about bubbles is Extraordinary Popular Delusions of the Madness of Crowds, and it was written a long, long time ago, before 1900. And it covers the tulip bulb mania that happened in 1600 and something. And the people just got crazy about tulip bulbs in Amsterdam. And there never was an explanation as to why people went so crazy on tulip bulbs. People have examined that. And the same with the 1929 stock market bubble. The same with the 2007 real estate bubble in the U.S. There's no real way to identify when it starts, and there's no real way to identify why it starts. It's quite amazing. But what's unique about this one, and it happened in the U.S. as well, is how widespread it was. There's been individual bubbles in things like .com stocks in 2000, or individual bubbles like the Florida real estate mania that happened decades ago. But to have it nationwide or even almost worldwide is extremely unusual. It's like a virus that's worldwide. This is also unprecedented as well. So.
Do you think every market in Canada is overvalued?
Yes, I do. And this is a controversial topic because certainly Montreal is much cheaper than Toronto. But and I got a lot of discussion going with people in Vancouver because they said, well, it's foreign money coming in. It's causing our house prices to go up, and the foreign money will never dry up. So therefore, our bubble is not a bubble. It's just something that's happening. And I said, well, how do you explain then the prices in Regina, Saskatchewan tripled in the last 15 years? Obviously from a lower base. I mean, if house prices go from 100 to 300,000, that's still a triple. And in Vancouver, it was more like a quadruple, and Toronto was a triple. The average for Canada all over is about a triple, and Montreal up until recently was quite a bit less than that, but they've now caught up to, so they've almost tripled. So the gains from say the 2005, 2004 era are pretty similar all across. Now there are some differences in the scale. For instance, in Edmonton, house prices tripled just in 3 or 4 years, and they peaked in 2007. And it's a little known fact that house prices today are actually lower in Edmonton than they were 13 years ago. And in Calgary, they're lower today than they were 7 years ago. So it's not a crash, but prices have stopped going up a long time ago.
So you write that home prices eventually return back to their original trend prior to the bubble, which you suggest would mean prices would have to drop by 50%. Is that how much you're expecting home prices to drop in cities like Toronto?
Yes. So it wouldn't get us back to the prices that were in place prior to the formation of the bubble. So just for example, pick a number. If house prices in Toronto in 1999 were 350,000 and today they're $1 million on average, a 50% drop would take it back to 500,000. And that's still significantly higher than the 350,000 2 decades ago. That would still be a 50% gain over, say, 20 years. That would still be a 2.5% annual gain, which would be, probably around the same as the inflation pace. We've actually got a chart, the bubble chart, which actually shows graphically quite nicely the pace of this thing and how it would look if the correction were to come at that rate. Yeah. So on this chart we show house prices, and you can see that at the top there, Vancouver peaked in single-family homes. Actually, Vancouver peaked in 2016. The second dotted line there you can see is Toronto. It peaked around 2017. And the solid red line that sort of goes up steadily from left to right is the debt. So the household debt has gone up pretty much the same pace as housing, 3.5 to 4-fold over the last 20 years. And then you got to go all the way down to the bottom to find things like inflation. So there's inflation, the blue line, which has leveled off recently, but it was sort of chugging along at 1.5 to 2%. And then at the second from the bottom is median after-tax disposable income. So you can see the problem is that the income that people have available to buy housing has not kept up at all with the cost of housing in terms of buying new housing. And that's where the gap has widened more and more as the time has gone by. So median after-tax disposable income is not even doubled from 100 to less than 200 over 20 years. But house prices have gone up 3.5, 4 times over the same period. So what that means is the gap has to be filled in by taking out larger and larger amounts of debt. And that is the problem. So if you look on here, just take the, say the average, say 3.5 times, and say that you had a 50% drop in the price of average house in Canada, would bring it down to about 175. So 350, half of that is 175. So you subtract 175 from 350, you come down to 175. It brings it right in line with the after-tax disposable income. Now that after-tax disposable income is based on pre-COVID-19 earnings. Now, obviously, earnings are going to drop significantly in the next 6 months or so, but hopefully that'll be temporary, so we can assume. So one of the mistakes that people make in a bubble is that they assume that the assets, whether it be stocks or houses, but especially houses in this case, can be sold in order to pay off any debt that's related to buying the asset. But in reality, over the centuries, it's shown clearly that that doesn't work. What actually happens is people pay off housing debt through income. And if their income is only relatively flat over the period, then their ability to pay back the housing debt is also limited. And that's what leads to the bursting of the bubble.
Now, you've cited easy lending as one of the factors fueling the bubble. How does Canada's household debt compare to other countries?
So we have a chart for that as well, the Canada versus U.S. household debt. And it shows quite clearly, I mean, all countries were on a trend towards increased household debt, but Canada is absolutely spectacularly ahead of the pack in this case, which is not a good thing, by the way. It's a bad thing. But of course, our house price increases have also been pretty much ahead of the pack, except for one other country, Australia. So we can see that household debt to GDP for the U.S. And Canada was roughly similar around 2010, but around that time in Canada, the government of the day, actually it was a little bit earlier than that, it was around 2008, and you can see how sharply that debt level goes up in 2009 on the blue line for household debt to GDP for Canada. And that's when we started to surpass the U.S. That was when CMHC, at the urging of the government of the day, brought in zero down payment at 40-year amortization. So if you had zero down payment requirements and 40-year amortization, pretty much everybody that has a job can afford to buy a home. And this really kicked off a massive surge in household debt. And you can see that the U.S. kept coming down, peaked in about 2000 and actually 2008, and it's been coming down ever since. And it's come down substantially. It's come down at 100 down to about 80, and of course Canada's gone up well above 100 now. So if the debt to GDP ratio is dangerous for the U.S. to the point where they basically triggered this household debt basically triggered a global financial crisis in the U.S. And in Canada, the unwinding of the housing debt bubble, or the household debt bubble, won't trigger a global financial crisis because Canada's too small a country, but it will be just as devastating to Canadians, and it will trigger a financial crisis in Canada as well as it did in the US.
So I've heard different arguments for the causes of Canada's high household debt. Some blame realtors and mortgage brokers. Others say it's because parents borrowed against their homes to give down payments to their kids, while others blame the government and banks. You've touched a little bit on the government role there. What do you think caused this in addition to those measures with mortgages?
Well, there's a whole bunch of different ways. The second edition of my book came out in 2018, and I added a whole new section about basically the causes. And so I talk about this a lot in that part of it. One of the things I discovered, it's been quite an amazing journey. One of the things I discovered that I didn't really understand, and I did train as an economist before I got into financial markets, was the fact that Canadian banks in general, not Canadian banks, commercial banks, can create money out of thin air when they allow people to take out a mortgage. So most people will remember this, when they went in and signed the mortgage papers to buy that house, the next moment after they signed, or within a few hours, the money, the $500,000 or $700,000, or until recently $1 million, would appear magically in their bank account. Now, the bank didn't allow you to just take that money and go on a vacation to Costa Rica. It controlled where that money went. It went directly to the payment for the purchase of that house or that condo. But that money did not exist before you signed those documents, and it did exist after you signed those documents. And the economics profession has it completely wrong. They still use the model that treats banks as an intermediary between the savers and the borrowers. So there would be a bunch of deposits in the bank, and then the bank would turn around and take some of that money from the deposits and lend it to that new home buyer as an intermediary and take a fee in the middle. That explanation has been completely debunked by several economists, and also the Bank of England and also the Central Bank of Germany have put out papers indicating that no, the money does not exist before, and it does exist after. And that creates new credit that goes into the system. Now, mostly 60-70% worldwide, maybe a little higher in Canada because of the housing bubble. The expansion of that credit over the last 40 or 50 years has been real estate related, because the rules are set up in such a way that banks get treated very favorably if they put out loans related to real estate. But on the other hand, if they put out loans related to entrepreneurs starting up a new company or even business loans or something, they're penalized quite heavily in their capital ratios. So the banks have found the easy way, and of course banks generally follow the rules. They very seldom break from the rules because they're doing just fine by following the rules. They don't have to cheat or anything. They follow the rules, and the rules say that it makes a whole lot more sense for them to lend against real estate. So it becomes a self-fulfilling thing, because the more credit that the banking system creates that's put into real estate, the higher the prices go, and therefore the higher the prices, the more lending for real estate that the banks can do, because they're constrained by they can't lend greater than 100% of the value of the property. But as we mentioned a few minutes ago, the constraining factor, which is about now to come in, is the income of the people that are taking out the loans. And there are ratios for that. It's a little bit more flexible, I guess. The banks can sort of, the rules aren't really hard and fast in that regard. So to answer your question, number one is the ability of banks to create money out of thin air. Now, the other way I would mention it was, you imagine a couple, they go with a realtor. Before they go with a realtor, they go to the bank. And the bank says, well, with your income and your future income prospects, and you both have good jobs and blah, 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 we could lend you up to $700,000 for a purchase, And if you take out CMHC, that means you could buy a home that was, worth $800,000 or whatever, and some number like that. So they go to the realtor, and first of all, at the bank, they say, oh, no, we would never want to borrow that much money. That's way too much money for us to borrow on our combined income of $100,000. That seems way too high. Then they go to the realtor and they say, show some homes in the $300,000 to $400,000 range, which we feel comfortable with. And they go and look at the stuff. And of course, as you know, it would be terrible. They can't stand anything they see. And so in front of the realtor, one of the two people in the couple say to the other, well, you know, the bank did say that we are pre-approved up to 700,000, you know, depending on the property. And the realtor goes, well, if you have that kind of limit, gee, I could show you some really nice places, you know, maybe not 700, but 600, you know, 650, 550 or something. And away we go. Well, where did that start from? Well, it started with the bank's approval or indication that they would be willing to approve up to a much larger number. So again, that's a factor. The other one that you mentioned in your question is really a big factor, and that is parents. And this is where I saw it initially, was the willingness of parents to help their kids buy houses. So we generally don't get asked ahead of time, unfortunately, but we for a while there, not lately, but for a while there, we were getting quite regularly requests for $100,000, $200,000 withdrawal from people's retirement accounts, saying they wanted to help their kids buy a house. So it was quite common, and I suspect it's still quite common, because really, how do people save up, you know, using those numbers, how do people save up the $70,000, $80,000, $90,000, $100,000 down payment for a $700,000, $800,000 home? It's almost impossible. Now, some people would argue that they're just not trying hard enough to save that money, but I don't think so. I think the house prices are so much higher than they were when I was at that point in my life, that it is substantially harder to save up that down payment. So the parents are stepping in. If I was given the chance to discuss it with them, I would try and talk them out of it. But the few times I haven't gotten it. You know, it's not something that where minds are open. They're pretty much determined that they're gonna help their kids get a house, because they believe that once you get on that housing ladder, the ladder keeps rising and it'll just push everybody up. And the later you get on that housing ladder, the harder it'll become to get in there. So they're helping the kids to get into overpriced housing with excessive debt, but they believe they're doing the right thing. So it's a combination of many things. And then the realtors definitely are a factor. The newspapers, the media is very much in favor of real estate investing. It's quite a eye opener, really. So all in all, it's hard. As a result of the book, I've been contacted by many young couples and have said something like this: you know, we don't feel comfortable taking out that big loan, and we don't really want to accept the help from our parents. But everybody in our lives, our parents, our in-laws, our brothers and sisters, all of our friends, they're all saying that you must buy. You're throwing your money away renting. And one person even said to me, renting is like taking your money, putting it in a pile, and throwing lighter fluid on it and lighting a match. And so you have to buy. And so people that are in that category are often really pressured, or even there's even some prejudice against them. They allege. I have to believe them when they tell me this, because they're not owners; they're just renters.
So debt and irrational consumer behavior is a driver, perhaps, of some of the high home prices. But what about other factors like immigration? So there is, and I'm just going to pull up a slide here as well. There is the argument that in cities, especially like the Greater Toronto Area, where there is a supply constraint due to the types of houses people want and the locations, there is a net immigration effect. Most immigrants in the Toronto area are highly skilled, and so they're working very skilled jobs. And they are bringing with them not only those incomes, but assets from savings or even proceeds from sales of assets in their home countries when they come. So the idea that they have more money when they come here is perhaps part of the reason that income growth doesn't tell the full story. So a slide here from StatsCan, for example, explains that argument looking at the Vancouver market, where income growth, of course, is not commensurate with home prices, but this idea that you have these immigrants with a higher rate of home ownership compared to Canadian-born counterparts making up the gap. So what do you think of that argument that the market, while it is very high in terms of home prices, there is some underlying factor there that is more, that might explain the gap, that it's not all completely unsustainable?
Yeah, well, I mean, I would refer back to Schiller's list of symptoms of a bubble, and you know, one of the main ones was people tell each other stories to justify the bubble, and it's amazing that Statistics Canada gets involved. You know, it's just I find it absolutely shocking that an agency like that would be putting out stuff like that.
So now, Hilliard, in bubbles, as in baseball, timing is everything. So what do you think would precipitate the kind of sort of tip us over the tipping point? Is the COVID crisis, for example, something that could be close to what we saw in the United States? In 2008, the subprime mortgage crisis was actually generated through the real estate market itself. COVID crisis is quite different. So I'm wondering whether it's impacted your views at all.
Well, you know, I said for 5 years now that because I kept getting asked this right from the very beginning, the beginning being in 2015. You know, well, if you're right, if there's a housing crash, what would be the precipitation? Because the argument was, as long as interest rates stayed low, there could not be a housing crash. Usually that's the way it came. And I said, well, a recession would do it. You know, simply with that much debt in the household sector. And actually now, in the last 5 years, it's now, it's increased, and now the debt is actually increasing very rapidly in the corporate sector as well. And a huge amount of the corporate sector is related to real estate as well. But just staying with household debt, we've never gone into a recession before with this much household debt, the ratio of household debt to GDP. And every time another country has gone into a recession with this amount of private sector debt, there has been a financial crisis in that country.
So obviously a severe housing crash, like you are suggesting, would hurt all of us. But the lucky ones, as you call them, sit on the sidelines and wait for prices to crash, would be able to buy a home at a discount. Now, I think all of us, everyone has dreamed of being able to time the market perfectly. But as I said earlier, timing is everything. In 2008, another financial advisor, Garth Turner, advised a generation against investing in homes due to a crash that didn't materialize in the time frame he suggested. When your book first came out in 2015, the average Toronto area home price was 600K, and now it's about 800K. And some are forecasting them to end higher by the end of this year in spite of the COVID crisis. And even the Canadian Mortgage and Housing Corporation's forecast for prices, which is the most pessimistic, they're predicting an up to 18% house price decline by the end of this year, suggests a full recovery in 2 to 3 years, with cities recovering at different rates. Toronto and Vancouver, for example, with different kinds of jobs, may recover faster because they're able to adapt to the COVID environment or post-COVID environment. So all of this to say, I think one of the things that makes us worried, that FOMO, is that in real estate, there are very real consequences to missing out. And you've touched upon some of them. The prices do get bigger. And I just wonder, at what point, what would it happen in the economy that should make me reconsider whether I should be sitting on the sidelines? Is there anything in your view? Is there any change in the data that would make you think that perhaps a bubble collapse is not as imminent?
Yeah, I mean, there's obviously potential reasons why somehow the bubble could get extended for another few years. Not so much in Edmonton, Calgary, and Vancouver, because it's already burst there. But in Toronto, I guess Toronto is really the last place that is really still arguing anyway that the bubble is still getting bigger. But, you know, I would tell people, you know, there hasn't been a recession for so long. Even the 2008, 2009 recession was pretty mild in Canada compared to elsewhere in the world. You know, people started to get and I'm really close to this because I talk to all my clients. There's a bunch of them and a whole bunch of other people about this all the way through recessions. And I've seen panic. I know what it looks like. And you can feel it through the phone line or through the emails. Well, I guess you'd have to phone them to really get the sense of it. But and it started to happen in 2008, 2009 in Canada, but it never really, the fear never really got a hold of people, never really got inside them. And so they didn't change their course of events, obviously. The housing bubble kept getting bigger. But in this recession, I don't see how we're going to avoid in Canada not getting to that point where people really start to question the wisdom of having that much debt.
Hilliard, the theme of our conference is smart caution. So it seems like a good time to get into what that means to you.
Well, caution indicates sort of a reticence, a realistic look at things. And whatever the housing price, I mean, it's impossible to say is, the house prices in 2000, 2001 at the bottom of the bear market in Canada, on average, were probably 200,000 across the country. And now they're probably 500,000 or 600,000. So there's no way for the average person that's coming up to their life, going through that stages of life, finding a partner, getting married, deciding to buy a house together, maybe starting a family, that sort of stuff. If the price is 500 when they get to that stage, or whether it's 200 when they get to that stage, who knows if the price is right or wrong. But one thing you can look at when you're at that stage is how much debt is involved. And that is the one thing that people could exercise caution with is, people have to understand the bank is not their friend, right? The bank, people at the bank have quotas set for a certain amount of mortgages that they have to sell, a certain amount of HELOCs. We haven't talked about HELOCs, home equity line of credit, car loans, credit cards, and their bonuses are dependent on them meeting their quotas. This came out in a big bank in the U.S. called Wells Fargo. Several people went to jail. All of the senior management of the company lost their jobs, I think. In Canada, CBC reported that there were the same kind of issues with some of the Canadian banks, from disgruntled employees, former employees, that sort of thing, that they had unusual pressure on them, put on them to meet their targets. And so the government asked the banks, is that true? Is that happening in Canada? The banks did a study and reported back to the government that they could find no evidence of anybody putting unusual pressure. And I'm laughing, of course. I tested it out once. I went to a bank. I won't name the bank because I think it wouldn't matter which bank. And I did and I had a young couple in mind, an actual real couple that we know. And they had been offered $1 million. And I was shocked that they were offered $1 million. They're in Alberta, but I was in Vancouver. So I knew the numbers, so I just put out the numbers to the bank officer there. And I said, what could they borrow? And this was in 2016, just before Vancouver peaked. And he said, $1 million, no problem. And then he said, depending on the down payment. And I said, well, we can help them with the down payment. He said, $1 million, no problem. So what bugs me about that is that young couple going in there, if the bank officer says that, then they might feel that they're still being cautious and they're being careful because the bank has approved it. When the bank says you're approved, I think it's safe for people. It's not safe, but it's understandable if they would get the mistaken impression that somebody at the bank and the government, because the government is obviously very closely tied to the bank, has done some kind of assessment of the risk of that and has concluded that it's not a risky thing to do to borrow that money. And it's not a risky thing to do to get into a situation like that. And so that's a major flaw in our system. So the theme of I would say, to add to the theme of the conference, do not rely on parents, friends, relatives, coworkers, the lender. Remember, the lender has pressure on him or her to meet their quota and to put that money out. That's pressure. Just, try to step back and say, is it really a good idea to take on that much debt at this point as we are in the recession with COVID and everything else? Maybe it makes more sense to just be cautious and be careful.
And the final question we're asking all of our guest experts: would you buy or sell a home right now?
Well, it's funny, when we first wrote the book, I said to my wife, maybe we should just sell our house. And I've always had this idea that living in a hotel would be fun, but she said if I did that, I would be doing that by myself. So I didn't want to do that by myself. So we didn't sell. And not only that, as I highlighted in the book, we bought a tear down, and the selling realtor told us it was a tear down. And but we didn't tear it down. We rebuilt it from the bottom up, from the studs, and so we put a lot into this home. We could never sort of, as we were going through that process, at one point I thought, oh, this is crazy. We're spending so much money. What we'll do is we'll just go out and find a home that's already been renovated. Well, there weren't any good. I live now. Edmonton's a small market, obviously, but in that category, in the area that we want to live in, there just wasn't anything available. So we sort of found the home. We put a lot of money into it, and we're going to stay here. So I would never sell. But I do say in the book for other people, and I would say it again, is that if you're at all nervous about the amount of debt you have and the situation that you're in, by all means, do something. Do something to reduce that debt. And if you're in your 60s or 70s and you want to maybe choose a different lifestyle, by all means, make that move, because you could get caught in the situation as we saw in the early 90s, where it becomes literally, real estate isn't as liquid as the stock market, so you can't always make those changes that you want to make. So it's good. Well, there's still surprisingly some pretty good demand in the real estate market. For sellers, it's not a bad time to be selling, even in a recession. For buyers, I would wait. For sure, I would wait and just see where this COVID-19 recession is going to lead us. I don't think you'll miss out on much, and you might get a really good surprise in terms of getting a better price 6 months or a year from now.
Hilliard, thank you so much for joining us at the summit.
Nice to be included in your group. It looks like an exciting summit. I really think you're doing a great job by bringing all these people together, and it'll be very informative for a lot of people.
Great. Thank you, Hilliard.